Hello, everybody. Um, you can see I'm in a rather relaxed retire here in the Christensen vacation home just outside of Copenhagen. We have an extended weekend here. We have a midsummer holiday in Denmark today. So I'm planning to spend most of the day with the family, but I thought I would nonetheless give you a little bit of an update on the global markets. But first, I will start out with a little bit of advertising here. When you're watching this, you're either watching it on YouTube, where Markets and Money Advisory has a YouTube channel. I encourage you all to subscribe to that. But you could also subscribe to the Markets and Money Advisory newsletter, and there you would see most of our video postings as well on YouTube via our website and via the newsletter. So please join that. Or you might be watching this on Patreon, where I have recently started a site. And the idea by the Patreon site is essentially to get you to become Patreons. We have a lot of corporate and institutional clients, but in terms of the following I have among students and private investors and so forth, they don't really sign up for our services, but many of them want to do that, and many of them also want me to do more of this kind of thing that I'm doing right now. So to essentially to fund that, you can become a patron on Patreon and support uh, the fact that I will do in the future more videos like this on market events and on economics and monetary policy, etc., on a weekly basis. And there is a little bit of a reward by doing that. If you become a patron and pledge $10 each month, you will also receive Markets and Money Advisory's quarterly publication, Global Monetary Conditions Monitor. So please join up there. But and you can see the links to these sites below. But let me get me back to what I really wanted to talk about this Monday morning. Uh, if you go through the economic commentary, if you go through the news flows on Bloomberg, on Reuters, read the Financial Times, you will see occasional stories about this and this country in trouble. Recently, there's been a lot of focus on Argentina and the plummeting peso. There has been some focus on the Turkish lira, and most of the explanations for the moves in these markets is driven by domestic factors, fiscal troubles in Argentina, in the case of Turkey, geopolitical risk, and an increasingly authoritarian regime, and so forth. But I would argue that most of this is driven by global factors. A lot of the movements we are seeing in emerging markets is really driven by the fact that over the past 1 to 2 months, or since mid-April, essentially, the dollar has rebounded. The dollar has started to strengthen as a reaction to the stepping up of the hawkish rhetoric from the Federal Reserve and the continued rate hikes from the Fed. That's really is the story. Uh, and essentially what we are seeing in terms of emerging market turmoil now, I wouldn't call it turmoil, but what a weakening of emerging markets in general, sell off in emerging markets, um, is essentially very much the same thing as we have seen in global stock markets and saw in the US stock market starting in February, a reflection of tighter global monetary conditions, not dramatically tighter monetary conditions, but nonetheless, we are beginning to see a reaction to that. So that's only natural, and we always see that. But we always also see when some emerging markets get in trouble, those who get in trouble when the Federal Reserve is tightening monetary policies are those countries which are already fragile, either for economic or political reasons. And what's the next country on the list? We already talked about Argentina. We have talked about Turkey. But I think something that comes up, what we do every I should say, reveal how we track the markets and what stories we find interesting. One of the things we do is that we have what we call a two sigma monitor, which we use for internal analytics. But I'll share a little bit of what we do with our two sigma monitor. Essentially, our two sigma monitor is just a tracker of market changes on a weekly, monthly, 3 months basis, 6 months basis, yearly basis for a number of markets, whether it's global stock markets, it's fixed income markets, it's FX markets, it's spreads, it's volatilities, and so forth. And what we simply do is we track whether any market moves more than two standard deviation in a given period, and then it gets a red score. And if it moves in a negative direction, and it gets a dark green score if it's moving in a positive direction of two sigma, two standard deviations. So I will also try to use the two sigma monitor as a way to create these weekly stories, the weekly takes on the market. Not necessarily what is everybody else talking about, but what do we see as something where the market is telling us that something is going on. And so what is the market telling us this week? Well, if we look at markets across different markets, I think one thing that is interesting is that the Polish stock market is down. The Polish zloty is down. When I say the Polish stock market is down, it's down in foreign currency, not necessarily in zloty, by more than two standard deviations over the past week. And we see something similar in the other Central and Eastern European markets, Hungary, Czech Republic. And why is this? Why is we seeing this? Well, I spent nearly 2 decades following Central and Eastern Europe very closely. When I used to be head of emerging market research in Danske. Danske had operations in Poland and the Baltics and in Russia. And for natural reason, that brought me to these countries quite often. I must say I have a nearly 2 decade-long love affair with Poland. It's a country that very close to my heart. I spent a lot of time in that wonderful country. And it's always ups and downs in Poland politically, but it has been a steady improvement economically since the end of communism in 1989. And of course, Poland joined the EU in 2004. And generally, Poland has done tremendously well, even in the last couple of years under populist government, which I'm certainly not a fan of. The country has done economically quite well and famously avoided recession in 2008-9. I do fundamentally think Poland was in recession, but that's another story. But overall, Poland has done tremendously well in the last couple of decades, in all the period I followed Polish economy. But we also see these periods where the zloty weakens dramatically. Poland, of course, essentially since 2001 have had a completely freely floating exchange rate and inflation targeting regime. And I used to say when anybody asked me about the Polish economy, I used to say we can describe everything as four. The current account deficit is 4% of GDP. The budget deficit is 4% of GDP. Growth is 4% of real GDP growth is 4%, and the euro zloty should be around 4. Those numbers are no longer right, but over long periods, that kind of was the steady state. The steady state now in terms of the zloty is probably that if we look at a purchasing power basis, the zloty should be trading close to 420. Exactly, our PPP model for euro zloty says 421. This morning, euro zloty is just around 430, so a couple of percentage points weaker than what PPP would say. So not a very weak zloty, of course, on a historical basis, where we're closer to the range of 4 to 410 on the euro zloty. This seems very weak, but PPP adjusted, it's probably pretty close to where we ought to be in the longer run, disregarding politics, disregarding everything else. But just looking at the purchasing power basis, we're probably fairly close to where we should be. So first of all, that we are trading here is not in itself very alarming. Where we were 1 2 weeks ago was very close to to PPP levels. So essentially, there hadn't been anything that really could would be said to be alarming. So what we are seeing now in the zloty, in my view, is that yes, the zloty has weakened rather significantly over the past week, and it has been gradually weakening all year. If we look at the Hungarian forint, the picture is very much the same. And then you could be inclined to say, well, Hungary and Poland both have quasi-nationalistic, populist, anti-EU governments. This is really the reason why their currencies are weakening. Well, these things certainly do not help. Um, but looking both at the Hungarian economy and the Polish economy, they're growing relatively robustly. Uh, they have quite strong external balances. Public finances in general, both in Hungary and in Poland, is fairly good state, in broadly speaking. So none of this is in any way alarming. None of this is creating any crisis. I can raise a number of structural issues in both countries, and I'm certainly very much in opposition to the nationalistic anti-EU rhetoric of both countries. But the weakening of the currencies in Hungary and Poland over the past couple of weeks has very little to do with that, in my view. It's mostly driven by the fact that the dollar has strengthened since April. And if we look at it historically, every time, and to stay in the two sigma rhetoric, every time we have a strengthening of the dollar, which is more than two standard deviations over a month, then you see some kind of quote unquote emerging market unrest. You see emerging market currencies coming under pressure. One can debate whether the zloty is a truly emerging market, but somewhere close to that in the old way of thinking about it. And that's really, in my view, the reason why the zloty is weakening. And that's the reason Hungarian forint is weakening. Is there anything real going on? Well, I think that what I really would watch is that if the Polish government and the Hungarian governments continue its anti-EU rhetoric, sooner or later this will mean something in terms of how much European taxpayers is willing to pay to these countries. Both the Hungarian government and the Polish government receive substantial transfers from the EU every year. In the case of Poland, around 3% of GDP comes from the EU. With the UK leaving the EU, there need to be budget cuts on the EU side. And why wouldn't you cut subsidies to Poland and to Hungary? Well, the governments of Poland and Hungary is not doing a lot to convince other European countries that they are entitled to get substantial transfers every year with the kind of anti-EU rhetoric, anti-immigration rhetoric, the general populist rhetoric. None of that is very beneficial in terms of creating a good relationship to other EU countries, and therefore it wouldn't be entirely stupid of market participants to say, well, there's some risk to the EU transfers, and that if those are reduced, essentially will worsen the external balances of these countries, and that on its own, of course, would be negative for currencies. However, I should stress that that, in my view, is not what is going on now. That is not what's going on. What is going on now is that, yeah, the dollar strengthening, monetary policy is getting tighter, and investors, for that reason, is taking some risk off the table. And in that sense, the zloty looks fragile. The Hungarian forint looks fragile because of the domestic factors, but also because they strengthened quite a bit over the last year. So it is only natural to take up some risk there. So we had Argentina and Turkey in the top, and then we get the Central Eastern European countries in the next round, and I think that's quite natural. For how long could this sell-off continue? Well, I think that if you look back, we could go a lot higher on euro zloty. Could we go to 450? Well, I'm not betting on that. But if you just look at the when the Fed initiated rate hikes in late 2015, 2016, these are the levels of where the euro zloty was trading. So we could go further in terms of weakening of the zloty, even though that would mean the zloty would become further undervalued. But remember, we are essentially only a couple of percent undervalued now. We could go to 10 or 15% undervalued if the Fed were to step up its tightening. I mean, when I'm saying stepping up, that would be hiking interest rates more aggressively than presently priced by the market. That's not my scenario. My scenario is that we have this kind of volatility in markets and some uncertainty and a gradual slowdown on the US economy, and that would get the Fed to realize that it shouldn't hike rates above 3% because then also it would invert the yield curve. But if all that happens, if the Fed push rates above 3%, the yield curve inverts, we have even more serious contraction in the unit use money space. Then, of course, the zloty will take a further beating. And that's, of course, the risk. And if you want to look at risk scenarios, this is where you're going to be. So I can understand that investors are a little bit worried about Poland, a little bit worried about Hungary at the moment, Argentina, Turkey. These countries are clearly fragile. But again, as I said in my comment on Argentina last week, this is not old school emerging market crisis. These are not pegged exchange rates. These are not a situation where we have very significant public finance troubles or external imbalances. So we're not facing traditional emerging market crisis. So in that sense, the zloty is not really different from the Swedish krona. Both currencies are presently have been weakening recently and then been weakening because of domestic factors playing together with global factors. But it's not something that should get us hugely alarmed. Of course, if you are a Polish citizen and you have your mortgage funded in Swiss franc, which used to be very popular in Poland, then you're less happy about the weakening. But from a global macroeconomic perspective, from a global financial stability perspective, no. Uh, no matter how much I dislike the Polish government, this is not some meltdown, and it's not driven by Polish politics to any large extent. This is still mostly about Jerome Powell, monetary tightening in the U.S., dollar rebound, and that is sending these mini shock waves through the global financial system, which is hitting some emerging and semi-emerging markets like Poland. Thank you very much, and remember to check out my site on Patreon, and please become a patron. Thanks.